What is CAS? Closing Auction Session. You must have heard a lot about it in the last week ever since it got implemented. Today, we're not going to discuss what it is, how it affects you, but today we're going to discuss something even more important, how to trade it. CAS, the closing or the settlement price on expiry day, might get manipulated by a few members, but how shall you take advantage or rather save yourself from that manipulation? Let's check it out today. But before we go into how to trade CAS, we need to understand the nuances of CAS. Alright, what happens? So here's a brief summary. From 3 p.m. to 3:15, a reference price is calculated by the exchange. What is this reference price? It is basically the VWAP of the last 15 minutes. That is from 3 o'clock to 3:15. Alright, when does the auction process start? It starts at 3:20. So there is a gap between 3:15 and 3:20, which is a 5-minute gap where there is no trading happening in the cash segment. Since there is no trading happening in the cash segment, the spot doesn't change. Now that's interesting. Now what happens in the auction process? Alright, in the auction process from 3:20 to 3:30, bids and offers, so buyers and sellers come together and place their orders. Alright, I want to buy Reliance at 1000 rupees, I want to sell Reliance at 900 rupees, so on and so forth. Alright, there is a range, a 3% band within which you can put a price to buy or to sell. Alright, now what happens? Based on these bids and offers, an indicative spot price is calculated by the exchange, both NSE and BSE. These prices are displayed on their website, and soon you'll be able to see them on our website, AlgoTest, as well. Now what happens? Between 9:25 and 9:30 at any one random minute, the auction process will stop and the final closing price of the day will be set. In the past week and a half, this has usually happened after 3:28, but it can happen at 3:27, 3:28, 3:29. We don't know. There's a lot of hue and cry, especially amongst the option traders and the trading community, against CAS. Not against the idea of CAS, but its implementation. As per the traders' understanding, the implementation can lead to a lot of manipulation. Let's understand how. Since during the CAS or the auction session, the trading volumes are very low, a few players can manipulate the settlement or the closing price. Now, how does it affect you as an option trader? Mostly during non-expiry days, this should not affect you. We've seen that on the data and we've seen that in the option prices. And we know that the settlement price or the closing price on a non-expiry day will not affect your option prices much. But when do they affect you? During expiry days. Why is that? Because the options are going to expire as per the closing of this auction session. Please understand. Let's say the reference price for the Nifty was 24,400, but due to less participation by market participants during this auction session, the price which was settled was 24,500, which is 100 points away from the reference price. Now this, as an option seller or a buyer, really affects your trading. If you are an option seller, your prices will move all of a sudden as soon as the reference price is determined. So we need to understand now how to trade this process. So let's get to it. To understand how to trade CAS, we are going to be on our platform, AlgoTest. I'm going to log into the platform. If you haven't created an account, you can easily create it with your phone number or your Google ID. All right. So here's the dashboard. All right. Let's understand what happens. All right. Let's go to the simulator. Usually what we have observed in the last 3 expiries is there is significantly higher premium left in the straddle close to 315. Why is that? The reason for that is the auction session, which as we have mentioned can be manipulated because of lower participation and lower volumes, determines your settlement price. Whether an option is going to settle or close or expire at 100 rupees or 0 rupees. That is determined in the last 15 minutes. Well, from 3:20 to 3:30. The trading goes on till 3:40. Alright, now let's understand. Let's take an example of Nifty. There have been two expiries of Nifty. One had a premium of 90 rupees at 3:15, the other had a premium of around 50 rupees. Irrespective of what the premium is, let us try and understand what we can do. Alright, so let's take both the examples. 4th of August was the previous expiry, and let me go all the way till 3:15. Alright, and if I sell a straddle, I would have gotten around 100 rupees. Alright, so 2 strikes. Now, we all know if you sell a straddle, the margin required for selling a straddle on expiry day is around 3 lakh rupees. We all know that. So, now I want to take a risk defined trade. I do not want to lose 1% of my capital. That is what I want to do. So, rather than putting a stop loss, because the reduction in option prices and the increase in option prices are going to be so fast that there might be a jump in option prices and your SL might not hit, I am going to rather sell an iron fly or an iron condor. Let's take the example of an iron fly. So I know that I am going to limit my losses at 3,000 rupees, which is 1% of 3 lakhs. So 3,000 rupees is essentially 50 points, 50 into 65, approximately around 3250 or something like that, but around 3,000 rupees. 50 points is 1 strike plus the credit I get from selling the straddle, which is 100 rupees or 2 strikes. So I'm going to buy my hedges 3 strikes away. Alright, if you want to understand, so yeah, loss is limited around 4,400, which is slightly above my 3,000 rupee limit, but whatever. But my position is risk defined to around 1 and 1.5%. Alright, now how did I find that? Very simple. I sold a straddle and I checked the credit. The credit was 100 rupees and I am saying I can take 50 rupees of risk. Alright, because I know after the auction process, either the auction process will end here at the top or at the right or at the left. In whatever scenario, I know that my loss is defined. So as simple as that. And based on this, I am making my strategy. Alright. In the current expiry which happened today, let's change this. We are seeing more rationality coming into the system, and by 3:15 the premium available was around 50-55 rupees. Alright. So we've gone from 100 rupees to now to 50 rupees, which is still much higher than what it used to be back in the day. Now, how do I trade it? Alright. Again, I have 50 rupees of premium and I am willing to take 50 rupees of risk. So I need to buy my hedges or my wings 2 strikes away. So I'm going to buy the put and the call. My loss is defined and my profit is defined. Alright. Now let's make the algo around this idea. Alright. The idea is very simple. The market is going to move very swiftly because the entire day's volatility has now been squeezed into the last 10 minutes or from 3:20 to 3:30. I am expecting that my stop losses might not hit, which is why I am making a risk defined trade, especially if you're trading with a lot of capital. What are you doing? You're selling a straddle or a strangle. You're taking some risk, around 1% of the capital deployed without the hedges. Alright, and that is how you're trading. So let's make a strategy around it. Very simple. I'm going to have an entry time of, let's say, 15:15 and an exit time of 3:32. Alright. Now here's the thing which is going to change. The strike type I am going to take with respect to the synthetic future. I'll tell you the reason why. Alright. And based on that, I'm going to sell a call and a put. And since we've known now that the market has rationalized, the straddle premiums have reduced from 100 rupees to 50 rupees, and 50 rupees more is the risk I'm willing to take. So the hedges I'm going to buy are going to be OTM2 for the call and OTM2 for the put. I am not going to backtest this strategy because there's not a lot of data around it. This strategy is entirely based on logic, that whatever premium is there left at the end, because there is a lot of volatility, I want to capture it, and I want to capture it in a risk defined manner. Now let's save this as my CAS strat 1. Okay. Now this is my first strategy. Alright. Let's say I have 10 lakh rupees of capital. Am I going to enter all these three together? No. I want to enter one at 315, another one at, let's say, 321, and this is where I'm going to tell you how synthetic future helps. Now please understand, at 315 the spot stopped moving. What is moving is just the indicative close, which is here. You can see the website. We'll post the website link in the description so that if you don't know, you can check it out from here, or very soon you will have the indicative price coming on AlgoTest as well. Alright. So at 315 the spot stops. From 320 onwards the indicative closing price starts coming. Based on the indicative closing price, the synthetic future, alright. For those who do not know synthetic future, we are going to add a link here that describes what a synthetic future is. The synthetic future for this week's expiry starts moving. Based on the synthetic future, which is now linked to the indicative close, I am going to define the ATM, the OTM and my other strikes. Alright. That was the reason I've been using synthetic future as a strike selection criteria rather than the spot. Alright, because the spot is stagnant. Spot is going to be stagnant till 315 and then it's going to jump directly at 330. Alright, so I have made one strategy at 315, another one I'll make at 321, let's say CAS 2, and another probably at 326. Alright, same strategies, nothing has changed. What is the objective? The objective is to increase the green cover of my payoff graph in a risk defined manner. Alright, now let's say for some freak reason, because it can be manipulated, and I can show you how it is possible. If you look at the volume, I don't know if this volume is correct or not, but definitely shows the vast difference. Now we can see that this was the FII DII candle and this again was the FII DII candle. This was all the retail candles. Alright, so institution candle had a volume of 31 million. The CAS candle had a volume of 885,000. But if you go on a non-expiry day, it is even worse. Volume of the institution candle is 26 million. Volume of the CAS candle is 54,000. Obviously, there is a potential to manipulate it. Alright, what am I doing? I am selling in a risk defined manner. What is my risk? 1%. Alright, now if you have say 50 lakhs and you're trading it with 10 lakhs of capital, that puts your risk even further down to 0.25%. Alright, but if you want to trade it entirely with your 50 lakhs of capital, that puts your risk at 1%. Alright, so this is how I have been trading CAS and I will be trading CAS in the future. It is an event and we need to play it like an event. There is an event risk every day, especially on expiries, and there is a premium around that event which I want to grab, and this is how I'm going to grab it. This is one such strategy that I placed in the market, very simple, risk defined. I had sold an iron fly with the same logic, selling ATMs and buying OTMs. I had taken more risk, you can take less risk, it all depends on you. I hope you enjoyed today's educational session on how to trade CAS or any event. If the event is unknown, something new can come up, you have to trade it in a risk-defined manner. And when I say risk-defined, I do not mean SL on a leg, because that can skip, and it can skip something like you put an SL on 100, but the next tick is 120 and you're chasing it. I do not want that. I want a risk-defined trade wherein I'm defining, I want a 1% risk, 2% risk, 0.5% risk. It's upon me to define that. All right. So let's summarize. CAS, good or bad? Not the topic for today. How to trade CAS? In a risk-defined manner, like an event. How to trade it in an automated manner? Through AlgoTest. I hope you liked today's educational session on how to trade any event. And nowadays, you have an event twice a week. I hope to see you in the next video. Till then, thank you and subscribe to our channel for more such videos.